Hi everyone, welcome to Seeing Value. So it's probably been such a long time since I've actually made a video that it's quite refreshing to actually get back into this. So yeah, before I make a start, if you've got any comments or questions, post below, or any companies that I haven't followed up for a long time, feel free to just post below as well. Also feel free to like and subscribe, always really helps the cause. Alright, so let's just jump right into this. Like, one company I know you guys are very interested to kind of chase up on is Catapult, because this share price has really dropped so much. And the biggest question is why? Well, when you invest in a growth company, inevitably when that growth falls, the company stock falls as well. But there's also the opposite, where if the growth increases in the future, the stock price comes back up in the future as well. So we're looking at a company that used to trade fairly high, like $14, $13, $12, and then it's just slowly slumped with the market. The market has kind of not really loved growth stocks for a good while. Like, there's been a re-rating of sorts with growth stocks. But of course, this $3.18 price tag is amazingly low. Does it mean the company is terrible? Probably not quite, but it does mean the market is definitely out of favor for such a company. And I guess something like having the right patience generally pays off with this type of company. Yeah, like, I don't think there's a quick fix or something that you immediately buy today and hope to do well in a month's time. I think when you buy into these companies, you got to have a very long-term horizon. At least in the aspects of, you got to let the company do its own thing, show its growth, and then basically it starts to perform. And over time, you really see it in the share price. Currently, you're at basically the all-time low. Yeah, no one really wants to be at the stage of investing where they buy into something and it just drops so much that you're questioning yourself whether you should hold it, sell it, or buy more. And those are individual decisions that you have to judge on your own personal circumstances, of course. So yeah, let's look at Catapult and go. They released their financial results, and after they released their financial results, basically mayhem took over, and this stock dropped from around $9 to less than $4, close to $3 now basically. And the biggest question is, is this still a good company? Is this worth buying more into? And that's what we're really investigating today. Alright, so like all things, we can look at anything about the company, but at the end of the day, the financials are going to be the most key part of the company. And total revenue for that quarter, for the second quarter of 2021, was $77.5 million, an increase of 27.6%, which is incredibly low in terms of the growth that they used to kind of deliver. Like, you take this growth here and you add it to the prior 6 months, and basically it would have been $158 million, which would have been a 52% increase on the prior year. So basically, you're adding this growth figure and you're adding it to the prior growth figure, and you still get 52%. That's to really show you how low this growth figure has really sank. Which is kind of disappointing, because you kind of hope that a growth company can continue, especially when they've given us a really strong guidance. When a company gives you a strong guidance of $300 to $400 million, and all of a sudden they take it back, it's kind of disappointing, of course. And it's also a sign of great uncertainty, and no one likes uncertainty, especially in the market. And it's showing that potentially in quarter 3, growth rates will not look too great either. But they hope in the longer term that things do brighten up. So let's break it down for what it is that it's presenting today. So for 6 months, $158 million, which isn't bad. Like, you look at the company valuation today, $307 million. So $307 million is incredibly low, especially when we consider for the 6 months, they've done $158 million. You know, basically, if they continue on their current trajectory, they're going to do one-time sales. This company is literally selling potentially on just one-time sales, which is incredibly low. You know, never mind enterprise valuations, right? Because they hold quite a decent amount of cash. Now, if you scroll down right until the assets, you can see they have $109 million in cash. Yeah, you see it right. It's in cash, right? $109 million in cash. And basically, the valuation of this company is $307 million. So you can kind of see that something's tremendously undervalued at this stage, of course. But of course, it begs the question of, is this company, not performing, and what happens if it continues to underperform? So that's kind of risks about investing in these type of companies. But I think they're kind of set up in a way that that they continue to succeed, at least to some degree. Like, we can't predict how successful the company is going to be every quarter, but of course I think they do have quite a good long-term future, particularly in this type of business model that they've kind of figured out can work quite well. I think you probably have to take a lot of confidence in the fact that the CEO brought $85,000 of shares. $85,000 of shares is not something you just put down just to, as a sign of just to willy-nilly. You do it as a sign of confidence. So as they put it, CEO brought 25,000 shares at an average price of $3.40. So if you buy at this price here, you're buying cheaper than what the CEO is buying it at. And the CEO only wants to buy these shares if they know the future is going to be pretty good. And this guy, I like the way he's going about it. He's buying shares on the market. And I think, there's no better sign of confidence from the CEO that the future of the company will do well. But it's going to take some time, of course. When you look at a company and you go, how long is it going to take to do well? These things can take a year or even 2 years or even 3 years, Of course, we're not saying you have to wait that long, but it's potentially that you could have to wait that long to see those really big rewards on this type of company. I think that, this is a company that has, in a sense, it's built up some good relationships, but the type of business model that it runs, it kind of depends on these partners doing well. It's a slight different business model to your traditional buy now pay later companies, which have a more wider kind of exposure, because these guys basically first they sell you a lease, but you have the option where if you pay down what you've brought early, then you can actually cancel that lease, and it just turns out to be a buy now pay later option. In a sense, they have a more, slightly more complicated business model than like a firm or Afterpay or something like that. And they do rely on, say, these companies also performing well. And I think the last time Wayfair reported, their sales figures were down quite several percentages. And if their sales are down, it's going to affect Catapult as well. I think that's just part of the reality. But of course, Catapult can, as long as they continue to add more new retail partners, which for the second quarter they added 31 new retail partners. So there's still some momentum going in this company. It's just not as quick as everyone kind of thought it would be. But of course, I think it's a dramatic overreaction towards these results. Like 27% is still very, very decent. And basically, you're getting this company at one-time sales now. basically 300 million. Like, they're probably going to do around about 300 million in sales. Yeah, and they also hold 100 million in cash. And their net loss was $8.1 million, and it's down from a 5.1 million net income. But if you adjust it, of course, it is 1.5 million in net profit with the adjustment. So, in the scheme of things, this company is, in a sense, cash flow positive. And yeah, it just has the cash sitting there for its financing activities, of course. So yeah, like as they said, they're basically taking off the guidance, as they say here, given the current macro trends and uncertainty, to accurately predict our consumers' buying behavior for the remainder of the year, we believe that it is best to remove explicit guidance for the remainder of 2021. While the short-term outlook may not be 100% clear, we do continue to believe in our mission, our core business fundamentals, and are extremely pleased with the progress of our strategic investments that will drive long-term growth. We expect to have more insight in these new and evolving patterns by our third quarter earnings call. So that also gives you a bit of advice, in a sense, by the company. They say they don't know what's happening in this current market because they kind of predicted how consumers might buy things, but then all of a sudden second quarter came and they got shocked themselves. It just sounds like management didn't actually see this coming themselves, because basically as a company you usually look at your metrics and then it gives you the ability to predict things going forward. But of course people don't always buy things as you predict them to be, and it's happened this way basically, and the company doesn't know. They need another quarter to really see how things go before they actually know what's happened. Like, they had a really good, first quarter, and they had a really good prior 12 months, but all of a sudden they've had a second quarter which was abysmal, which was still 27%. Like, when some companies grow 27% in that quarter, most people can be pretty happy. But of course, we're dealing with a smaller company that we invest in to hope that it actually grows quite quickly, and obviously that has not happened. And now we're in a situation of, well, what just happened, and what does the company itself expect? The company, has signaled it needs more data. It needs to look at the third quarter before it knows what's going to happen next. So yeah, I think at the current share price, it is still, it's cheap for what it is, of course. But of course, we could have been looking at the $10 mark and feeling like this company was cheap. And that's a question: how cheap can a company get before it's not worth it? Because this is a company making good profits, right? Well, in a sense, decent profits. They're not losing money in that sense. If you make adjustments for certain expenses, the company's not actually losing money. So as long as the company doesn't lose money, and it's still able to show some growth, basically things should continue to head in the right direction. They've also taken some more productive, approaches by offering consumers the ability to directly apply with them, rather than going to, say, like a company like Wayfair, buying off Wayfair, then being led into the lease approach. They can actually go right to Catapult, know they can get this item for lease or buy now pay later situations, and then go to Wayfair or Lenovo or Simply Mac. Yeah, I think, like, based on all these stores, they kind of look average. They're partners. Like, Wayfair looks like it's by far the bigger one, and that is true. They do get most of their revenue from Wayfair. So if Wayfair dips, they kind of dip. And I think basically the future, when Wayfair releases their next quarter results, if it's good, it's good for Catapult. If it's not great, then it's probably going to affect Catapult in a very, very similar way as well. So use Wayfair as a good indicator, because they're by far the way kind of the partners that help them generate the most revenue. So that's kind of those things that you want to consider when you try to gauge how strong this company is going to be going in the future, and the results that are going to be released. But yeah, I think from the current situation, the company is extremely cheap. Like, I didn't expect this company to come down this much, but now it is. It's cheap if you're willing to hold, of course. Like, if you're not willing to hold, it's going to be a long wait. If you're kind of the investor that can buy something, put it in the bottom drawer, and then come back later, I think you'll be pleasantly surprised when it does well. But if you're holding it, and if you brought it at a high price, and then you're looking at the current price, you kind of feel like, what do you do? Like, firstly, that is one of the lessons of buying into a growth company. Sometimes growth can drop quite heavily, and when growth drops heavily, the share price can drop heavily, and that's the risk of buying into growth stocks over blue chip stocks or something like that. So of course, when you consider buying into growth companies, you got to consider the risk. But of course, Catapult is probably in that middle situation where it's established itself in a good way, but of course it still relies too much on certain retailers like Wayfair, and as it continues to build on, it's going to be able to find more retail partners, and then slowly spread that kind of revenue base with other kind of retailers. And as basically they've onboarded 31 new retailers, the more retailers they continue to onboard, that's going to be a really good sign of them being able to diversify, having to rely on Wayfair way too much. And that's kind of my view of Catapult so far, that they rely on Wayfair way too much. Wayfair revenue has dropped. It has affected them and their growth rates, and they haven't found other partners as strong as Wayfair. I hope they do in the future. If they do, that is the single biggest buy signal ever. If they can find a really, really strong partner similar to the size of Wayfair, then you can be at ease that their revenue has been diversified, and their future growth rates will actually be more consistent. But right now, the growth rates aren't as consistent because they rely too much on just one big partnership, in a sense. But so far, company-wise, they have 100 million in cash. They are basically, on an adjusted basis, they still make net profit, and they still have a lot of money in the bank. So yeah, I wouldn't say there's a lot to be worried about. But of course, the biggest worry is the growth rate itself, that it's come down. I think if you're in it for a long run, put it on the bottom drawer, come back to it later. I think the company's, it's still fairly in good stead. Like, it's a drop in growth rate, but this can happen, and it's not entirely the worst thing. There are companies that have much worse problems. Some companies have big debt problems. Some companies have fraud problems. But that's this situation is okay. They dropped in growth rates, but the company itself is still here. It is still growing. It is still moving forward. And we have a CEO who just brought $85,000 of shares, which is always a really, really good sign. And this is a guy that was named Influence Business Leader to follow in 2021. So, that's kind of like the recognition you've got with this type of CEO. That you've got a CEO who's, being named the most, an influential business leader. And that they're kind of showing it by their actions, which is always nice. and you understand where the problem lies. It is with Wayfair being a big partner, but as time goes, they can sign up more retailers, and that's going to help the company more. The time that you might not feel too good is when they don't onboard any more retailers. Then that's going to be a bad sign, or when their net losses get bigger, because obviously those are indicators where things aren't going so well. If we come down here and we do just like a breakdown of their revenues. So yeah, like rental revenue obviously is a large part, and it has increased 77 million, up from 59 million from a year ago, and for the second quarter, of course. So we can look at the biggest expense is bad debt expense. Bad debt expense jumped from 3.2 million to 8 million. So basically, people brought stuff, they weren't able to return it, and that's the risk of doing their current business model when people can't return the money. And it looks like the expense has jumped remarkably high. Like, it's more than doubled, whereas revenues have not more than doubled. So if we were to do it on a scale basis, you can see that bad debts has clearly gone up significantly more than what revenue has gone up by. And the same thing with compensation costs. Compensation costs has gone up by quite a bit, from around 1.8 million last year to 14.7 million this year. So you can see where those extra costs are actually cutting in, hence why they're making a loss of 8 million. But I imagine this compensation cost, once adjusted for, that's basically where it's coming from. Yeah, so it was stock-based compensation, so it was a non-cash expense. When you add it back in, they were actually making a good net profit. So if we add back in the stock-based compensation, what's the 10 million, and I made a loss of 8 million, this would actually be positive 2 million. So you can kind of see where these figures, in terms of if you break them down, they're actually not too bad for the company. They are still in a profitable situation. And yeah, I think that's more or less all of what I had to say. Like, don't mean to drone on, but hopefully that just gives you a breakdown of everything. And it's been a while since I've done a video, so these videos first time around, after a while, yeah, it kind of takes a little bit longer than usual, of course. But yeah, like, feel free to comment on any companies you want me to look at, or just any comments in general if you really want to. I'll see what I can do in terms of some more future videos, and hopefully not leave it to too long, of course. Until then, good luck investing, everyone.